Welcome to Group 8's presentation, and today we'll be talking about ethical failures in superannuation, the case of CBA, insights from the Royal Commission and CFA ethical standards. And on the screen here are my group members. And firstly, this is the content that we'll be covering, and first I will talk about specific issues uncovered by the Royal Commission. The Royal Commission uncovered a series of serious ethical and operational failures in the Commonwealth Bank of Australia superannuation operation, especially under the Colonial First State Investment Limited and Aventos. A central issue involved the delayed transition to MySuper products. Despite obtaining approval to offer MySuper in 2013, CFSIL failed to timely transition thousands of members' accrued default amount into these lower fee legislatively mandated account. Internal communication suggested these delays were partially motivated by a desire to retain ongoing advisor commissions, prioritizing revenue over members' benefits. Another significant issue was the charging of fee for no service. CBA subsidiaries deducted advisor fees from member accounts even when no personal advice or service was provided. In some cases, this practice continued for years and involved customers who had passed away, revealing grave shortcomings in internal controls and governance. Additionally, the continued use of grandfather commission under the pre-FOFA future financial advice agreements demonstrated the disregard for the intent of reforms designed to reduce conflict of interest in financial advice. These commissions incentivize ongoing payments advisors regardless of whether any new service or advice was provided, often to the detriment of fund members. The Royal Commission also criticized CBA practice of selling superannuation products through its retail bank branches. The evidence showed that the frontline staff were incentivized to meet sales targets rather than to assess the suitability of products for individual customers. This created an environment in which products recommendations were driven more by internal sales priorities than by clients' financial needs. Furthermore, the returns provided on cash investment option with CBA super funds were unusually low, and the bank was found to have invested members' funds in related party products that may have not yielded competitive outcomes. These arrangements raised concern about whether trustees were generally acting in the best financial interests of their members. Lastly, the Commission found misconduct in the provision of intra-fund advice, including instances where advice were delivered by individuals who were not appropriately licensed or who had been banned by regulators. Cumulative effect of these practices revealed serious branches of trustee duties, pure risk management, and a pervasive failure to prioritize members' interests.
In the next section, I will explore the ethical issues and theories involved in this misconduct of CBA superannuation aims, which is the utilitarianism, deontology, virtue ethics, and ethical decision-making model. And the first one is the utilitarianism. It assesses actions based on their consequence, aiming to achieve the greatest good for the greatest number. CBA delay MySuper transitions and charge fee to decrease client, knowingly disadvantages thousands of members to preserve advisor commissions and internal profit. This decision clearly failed the utilitarian test and the benefit of few at the cost of many. Second one, deontology. It focuses on duties and moral principles, regardless of outcome. Under this theory, actions are ethical only if they respect rights and fulfill obligations. CBA trustees had a legal and ethical duty to act in member best interest, yet they ignore this duty by prioritizing conflict, sales incentive, and failing to prevent fees for the service. And the third one is virtual ethics, which is looking at the character and integrity behind decisions. Ethical behavior should reflect virtual like honesty, responsibilities, and fairness. CBA culture driven by sales target and profit motives is lack of this virtue and leading to systematic misconduct. And finally is the ethical decision-making model. This is a process organizations can follow to think through the dilemmas. It involves considering all stakeholders, thinking through different options, and looking at long-term effects. CBA didn't do any of that. They ignored the warning signs and made poor decisions without proper reflection. And together, this framework revealed that CBA behavior wasn't just legal problematic, it was ethically indefensible.
This section examined the direct and indirect consequences of CBA misconduct on stakeholders and industry trust. First, under the Section 29W8 of SIS Act, they failed to transfer 13,000 members' accrued default amount to MySuper products. They also breached the Section 912A1C of the Corporate Act by having inadequate internal system On top of that, they actively resisted the removal of grandfather commissions, violating the FOFA reform. In terms of customer harm, they have hidden fees in products such as first choice pension, which reduce returns, misled customer in essential super fund, where only 15% of customers receive general advice, despite many believing that they were getting financial checks. Charging fees, even member passed away, which led to 2.9 million of misconducts. Finally, they continue to use Com Insure, offering products that underperform but more expensive compared to other similar products. As the result, they are mandate to fee removals, reviews, and refund thousands of customers. CBA misconduct encouraged a stricter governance enforcement and financial advice regulation. Loss of trust in CBA reputation negatively impact the long-term economic benefits because when the trust is lost, even if the return is high, investor will hesitate to invest. It will also impact other funds since investor might follow others' investor action when there is lack of trust in the market. Employees following inappropriate procedures, such as giving personal advice, might be getting into lawsuits.
The CBA ethical standard could have prevented issue. So the first violated CBA standard is standard 1A, knowledge of the law. So if a profession as CFCL had upheld this standard, they would have immediately ceased directing contribution into non-compliant products. So escalate branch internally and prioritize regulatory compliance over business convenience. So all illegal practice wouldn't have continued after April's warning. So the second one is standard 1C, mispresentations. So had this standard been followed, communications to member would have clearly explained all options, including my super, without misleading language. So there would have been no scripts that nudged member away from better choice to preserve commission. The third one is standard 1D, misconduct. Ethical professions would have recognized that charging fee to decrease time or ignoring known breaches reflects poorly on integrities. So upholding this standard would have required internal actions to stop unethical practice, regardless of business pressure. So next, we have standard 3A, loyalty, prudence, and care. So this standard requires putting the client first. So adherent here would have meant transitioning members to my super products promptly, not delaying to preserve commissions. So ethical professions would have focused on improving member outcome, not protecting internal revenue stream. So another CFA standard is the standard 3B, fair dealing. Member would have been treated equally. So the firm wouldn't have prioritized high revenue members or tailor contact strategy based on profitability. So every client would have received consistent, fair commission and service. So the last CFA standard is standard 6A, which is avoid or disclose of conflicts. So many of the problems arose because members were told that advisors had a financial incentive to keep them in the high fee products. So greater adherence would have ensured full and fair disclosure to those conflicts, giving members the transparency needed to make informed decisions.
Hi, I'm Pramodh, and in this short presentation, I'll be discussing the social impact and systematic issues uncovered during Royal Commission into misconduct in banking, superannuation, and financial service industry, with a focus on Commonwealth Bank of Australia. The Commission revealed that thousands of customers were charged fee for no service, even from the accounts of deceased client. This is a significant loss of retirement savings, which is especially serious in a system where superannuation is meant to provide financial security in old age. The people most affected were everyday Australians who needed the most protection, like older people, low income earners, and those who did not fully understand the fee they were being charged. Beyond financial harm, many experienced emotional stress, feeling confused and betrayed by a bank they trusted. This misconduct also led to major loss of trust in the financial system, with some people avoiding financial advice altogether of fear of being taken advantage of again. This misconduct wasn't a one-time mistake. It happened because of deeper systematic problems, like sales first culture where staffs were pushed to sell more products, even if those products weren't right for the customer. There was a conflict of interest where advisors earned commission for recommending certain products instead of doing what's best for the client. The Commission also found that regulators like ASIC and APRA did not take strong action even though they knew something was wrong. To make matters worse, the products were often too complex, hiding fee and making it hard for the customer to understand what they were paying for. All this shows lack of ethics and accountability. These are the references for the content we used in this presentation. To conclude, as noted in the Royal Commission report, these failures cause real harm. To rebuild trust, the financial industry must follow stronger ethical standards, be more transparent, and always put customers first. Thank you.